welcome everybody to another episode of Capitalize on Retirement. Brandon and I are joined today with special guest, advisor, and partner with us at Capital Way Wealth Management, Mr. Paul Kiefer, or as we reference him, Uncle P. Paul and our father have probably been the two biggest mentors in our lives and our careers, so we're very happy to have him. Paul comes with 53 years of investment experience. I don't know anybody else who has 53 years, so we're excited to have you.
Neither do I. Everybody else would be dead by now, so I'm just happy to be here.
Yeah. So we're really excited to have Paul today. We're going to talk about, discipline in the market, not timing the market, and just perspective in wealth building over such a long tenured career. So we're going to talk about, the market's change, headlines shift, but successful investors always stay the course. So, Brandon, you kind of want to hit on.
Yeah. So, Paul, I know Dave and I and a lot of our advisors here have gotten so much from you over the years, and just the knowledge that you have. Yeah, we felt like it was, this is going to go out to hundreds, if not thousands of people, and, we just want to pass those lessons on. So, Paul, if you could just kind of tell us some of maybe the early days in your career and why you got into this business, or, maybe anything you want to talk about there.
Well, it's funny, when I started, Brandon, excuse me, I was 22 going on 23 years old. Excuse me. And when I talked to some of my older clients, and one of the things I used to get from them all the time was, Paul, I want something safe. And I used to ask them, I said, well, tell me, what is your definition of safety? And it was always the same thing. Government-backed, guaranteed, can't lose my principal. And in my 53-plus years, they never, ever gave me the answer I was looking for. My definition of safety, I want something that will grow as fast or faster than inflation. Keep me ahead of the game. That's the key. Because, if you walk into a Walmart today, you'll get to see a 70-some-year-old white-haired greeter.
Yeah.
If you go into a McDonald's today, you might see a white-haired person in there scooping fries and flipping burgers. When I was growing up, teenagers worked at McDonald's. And when I see that, my first thought is, are they there because they want to be there? Because they have to be there. More likely than not, they have to be there because they either didn't save and invest, or they didn't put anything away with any growth potential. They never got beyond a savings account, a CD, a fixed annuity, nothing with growth. And inflation and taxes will wreck you every time, and it'll be a guaranteed loss.
Yeah.
We talk about that all the time. Taxes, inflation, we have to make sure we're keeping pace with that. That's a great thing, Paul. I want to talk about, I know when you first started, the trading world and the whole environment looked a lot different. You mind taking us back into that a little bit?
Well, I tell you, but I call myself the Fred Flintstone of technology. And it's so great to partner up with you guys. You're so much younger than I am. I think the problem today is the instant gratification. You got that 24/7. And everybody wants to, it's hilarious. What I tell my clients, if you won't commit to a minimum 5 to 7 years, and I'd rather talk 10 to 12, but at least 5 to 7, I refuse to take the money. I don't know when the next October 19th, 1987 is going to come. I don't know when the next 2008 financial crisis is going to come. Nobody does. Nobody does. So you have to have that time horizon. And it's funny, you'll take people's money and they'll call you back 3 weeks later and say, how am I doing? Okay.
Yeah.
Well, you might be doing really well, maybe not so much. I've also had this happen to me. Well, I want something that I can double my money like in a day. Well, anything that can double in a day can go away in a day. Yeah. That's not investing. Okay? That's not investing. Yep. That's Vegas.
That's gambling.
Yeah.
That's gambling. That's red or black.
Yeah.
Okay? So the key to making money in the market is never, ever getting scared out of it. And the two key points are time and patience. If you have those two things, I guarantee you'll do well. If you don't have those two things, you might do well, but you might not do well.
Yeah.
That's the key to the whole the whole deal. And,
Yeah.
you know,
I mean, I was going to say, Paul, I think that's great. And, you know, a lot of our clients, we preach the same things to them. It's just about being in the market for the long term.
yes.
You know, and I know there's a story that you told us, and I think this was great because a lot of what we do as advisors is really making sure our clients never make that decision. So if you could just talk about, you know, Black Monday and kind of
Sure.
what that looked like.
The Black Money, for anybody listening who doesn't remember it, the market went down 23% that day. I still cannot find anybody that could tell me exactly why, but it was just something that kind of fed on itself. The momentum started. And the one thing I remember about it was I was on my way home that night. I was actually on the phone for 3 consecutive days. My left ear was red and swollen. I looked like a boxer that got hit too many times. And one of the best things that would have happened to me on the way home, I had the radio on, and this DJ was on, and he was laughing about it. And the reason he was laughing is because he didn't have any money. And I thought to myself, you know, I'm down 23% today, but would I rather be me, or would I rather be the guy who didn't lose anything on paper today because I didn't have any money?
Yeah.
I'd rather be me because I knew it was going to come back. It was just a matter of time. And Brandon, there's 2 emotions that control people when it comes to their money: fear and greed. Now, there's nothing wrong with those 2 things. The problem is human nature makes them work at the wrong and opposite time. It makes you fearful when you should be greedy, and it makes you greedy when you should be fearful. And when you think about it, everything that we buy in life, food, clothes, cars, furniture, whatever it is, we'd like to buy it on sale if we can. Everything except our investments.
Yeah.
When they're on sale, we're afraid to buy them. When they're fully priced, we can't wait to buy them.
That makes so much sense. It's funny, you know, when the market's doing really well, like it has over the past couple of years, it seems like everybody's calling saying, hey, I have extra money, I want to put money in. But when the market's going down the other way, it's like, hey, it's just going to keep going down. So buying things on sale is a good thing.
Yeah. Well, I get one quick example on that was a good friend of mine. This was 2017-18. First 2 weeks of the year, the market got pounded. And I looked at his Roth IRA account, and it was down 10%. And I called him on the phone, and I said, hey, get in here right now, give me a check for your Roth this year. I said, it's down 10%. And there was silence on the other end of the phone. And he said, geez, Paul, down 10%. I don't know if I want to do that right now. I said, really? I said, you know the funny thing about that? If I called and told you, hey, the market's up 10% for the first 2 weeks, get in here right now and give me that check, you'd break your arm getting in here and give me that money. So what you told me was, you don't want to pay a 10% discount, but you'd be more than happy to pay a 10% premium.
Yeah.
And that makes no sense at all. It's like you're going to a wedding and you want to buy a new suit, and you get to the mall and everything's 50% off today. Do you say, you know, I really don't want to pay 50% off for this suit. I want to wait till they mark it back up to the regular price, and then I'll buy it.
Yeah.
And that's that fear and greed working against us, right? Because you mentioned that everybody knows we need to buy low and sell high, right? That's the goal.
Right.
The problem is we don't know when it's going to be low. We don't know when it's
Yeah.
going to be high. And
Right.
that fear and greed kind of works against us at the wrong
Right.
times.
And you know, Dave, I mean, it's funny. People say, Paul, when's the best time to invest? My answer is when you have the money.
Yeah.
Because you don't know what it's going to do tomorrow. I once had a client come in. The Dow had just hit 17,000. It's now 47,000. And he came in and he said, I have some money I'd like to give you, but I can't give it to you now. And I said, why is that? And he said, the market's too high. Dow is 17,000. I said, that's a really big number, isn't it? He said, yeah. I said, how big is it compared to 20,000? And he said, why, you think it's going to be 20,000? I said, it absolutely will be. And he was reaching for his checkbook. And I said, no, oh, hang on. I said, it's going to be 20, but it might be 14 before it's 20.
Yeah.
And that's when the light went on.
Yep.
Yeah.
Yep.
And what do you say? 75% of the time?
Well, the market goes up 70 to 70% of the time. It goes down 25 to 30% of the time. And what I tell my clients is I wish I could find a game like that in Las Vegas.
Yeah.
Where I'd win 70, 75% of the time, because if I found that, I would move there and never leave. I'd sit and play all day, but I'm not dumb enough or naive enough to think that they built all those beautiful hotels and casinos so I can make money. That's not why they're there.
I think that's why we've been such a good fit together, because our safety income growth philosophy complemented that philosophy all those years. I mean, one other thing, and I think this is important, you've seen a lot of market crashes throughout the years and a lot of uncertainty in the market. And I know even this last one that we saw in April, you and I had a conversation, and you kind of gave me a great analogy on how it's different every time. I wanted you to share that. I think it was so important.
Yeah, I mean, if I had $1 for every time I heard, Paul, it's different this time, okay? It's different every time, all right? I mean, I've seen so many things throughout the years, the financial crisis, the Black Monday, the whole deal. And what I tell clients is, I've seen this movie before. The beginning of the movie might be a little bit different. The middle of the movie might be a little bit different, but the movie always ends the same. Okay? And when I think back, David, to Black Monday, I had one client that was literally, he was ready to find a bridge to jump off of, okay? And I talked him down. He was good. He came into my office 10 years later, okay? And he was laughing about it because of what the market had done over that 10-year period. And I said to him, I said, you know, you're the type of client, a person that you can't take market declines. I said, now let me ask you a question. Has the market ever gone down and not gone back up? And he said, no. I said, so there are only two different types of declines you can have. You can have a permanent decline, or you can have a temporary decline. If you only have temporary declines, you only have temporary losses, unless you do the wrong thing and panic and sell it at the bottom. Now what you've done is you've taken a temporary loss and you turned it into a permanent loss because you locked it in when you didn't have to.
Yeah, couldn't agree more. I mean, you've always said zoom out, right? If we zoom out, everything will be okay. It's, again, why we have to have that asset structure in place. And
right.
Couldn't agree more.
Yeah. One of the things that, we get a lot of questions about is just, Paul, I mean, and I get this question a lot, but Paul, what do you think about, putting money away consistently? Like a lot of our clients say, is it better to put money away on a monthly basis, maybe once a year? Should I try to time it when the market's down?
Right.
So how do you feel about, actually accumulating and saving money consistently?
Well, first of all, Brandon, there's no such, I've never met anybody in 53 plus years that could time the market. Okay?
Yeah.
And trying to time the market, the problem is you can't be right once. You have to be right twice. It's not only when you get out, but it's also when you're going to get back in. It's real easy to get out. Now getting back in. And I've had this happen where market goes down, you call, hey, it's a good time to get back in. Oh, Paul, I think it's going lower. Well, then it spiked up. And then you call them and you go, well, I don't want to do it now. The market went up. I once had a client that always looked for the perfect time to invest. Well, that never comes, okay? And when it does come, you don't know where it is until it comes and goes. When you look backwards and say, oh, gee, if I would have bought it here and sold it there, well, 20/20 hindsight, everybody's a genius,
Right.
okay? It's what's coming forward. That's the problem. This is what they don't know.
Yeah.
So it's all about buying good quality funds, stocks, companies, and holding them. And the key in the market is never ever getting scared out of it. That's the key.
It works. Compounding interest.
Yeah.
So,
And it's funny to see, because and I've been doing this for almost 10 years, Dave. I know you're a few years longer than I am. But, Paul, to look at some of your client accounts, you've been working with these people for 40 years, and just to see what those accounts have looked like over that 40 years. Yeah, you've had some years where they made money, some years where they lost money, but a lot of them are a lot farther ahead than when they started.
Well, Brandon, what makes me feel really good is I know that I've helped make a lot of people millionaires and multimillionaires that wouldn't have been without the help.
Definitely.
And I mean, it's so satisfying. We don't save lives like a doctor or a surgeon does,
Right.
but we make their lives a whole lot better. And the old saying, money's not everything. And I'm the first one to admit that. But it's a whole lot better with it than it is without it. And the one thing that I've noticed, a lot of people throughout the years that have told me money's not everything, they all had something in common. They all had money. So it's easy to say that when you have money.
Right.
Go ask all the people that don't have any money
Right.
how unimportant money is.
Yeah.
And they'll tell you it's very important.
It gives you a lot of freedom to do different things, charitable goals, give to your children, whatever it is. It gives you a
David,
ton
I
of freedom.
tell people when you retire, you might want to play golf every day. You might want to just sit on the porch and have a beer or a lemonade. But the more chips you have, the more choices you have.
Yep.
That's
I
true.
couldn't agree
That's
more.
what's key. And to be able to do whatever you want, whenever you want, go wherever you want, whatever you want, buy whatever you want, whenever you want, it's a very, very nice feeling. It helps you sleep better at night.
Yeah.
No?
And you mentioned just having a long-term time horizon. Like, I know, some people, especially nowadays, things are so easy to get and you can get them so quick. I mean, you order DoorDash, it takes,
Yeah,
20 minutes and the food's right on your doorstep.
right.
And if you look at it, it's like, hey, how do you have the patience for 10, 20 years of investing? But
Yeah.
that's what really makes a difference. It's just being in it for the long term.
Well, absolutely. And I tell everybody, never let short-term news that I call short-term noise control long-term investment decisions.
Yeah.
You get this, well, I don't want to invest now because I don't like President Trump. What about the tariffs? There's always going to be problems. These problems are all temporary. They're all going to get solved. And by the time they get solved, they're going to get replaced by a new problem.
Yep.
There's always problems. I once had a client, again, looking for the perfect time to invest, and he never did anything. He was on the sidelines. And I said to him, let me give you a little analogy. I said, what you're doing is like me saying, I'm going to get in the car and I'm going to drive to Cleveland or Pittsburgh today. But I'm not going to leave until every traffic light is green between here and Cleveland or Pittsburgh. Well, what's going to happen? I'm
You're
never
never
going to
leaving.
leave. I'm never going to leave because there's always going to be a red light
Yeah.
between here and there. And this is what he was doing. And I told him once, I said, you know what, it really doesn't matter for you what the market's doing because you don't have any skin in the game. Your money's all sitting in a savings account. Now, on the savings account thing, starting at the ages of 22, 23 like I did, like you guys did,
Yeah.
right? Again, the older people, well, I want something. I want something safe, okay? And I want something guaranteed. I said, okay, tell me, where's your money right now? Well, it's in the bank. And what's it paying? Well, it's paying 1%. But I don't have to worry about losing, right? I said, what's your marginal tax bracket? Well, it's 25%. I said, okay, so we're going to lose 1/4% to the tax man. So that leaves you 3/4%. What's inflation right now? It's about 3%. We subtract that, minus 2.25%.
Yeah.
I said, now what you wanted was something guaranteed, and you have that. It's a guaranteed loss.
Yeah.
The problem is inflation is such a slow, steady erosion that you don't realize you have a problem until you get out there and it's too late.
Yeah. That's
That's-
funny.
Big issue.
Yeah.
I mean, Paul, as we kind of look to wrap this up, I mean, obviously you've done this for a long time and you've been extremely successful in practice and personally. I mean, if there's anything you could tell your younger self right? Or today's investor, what's one thing that it would be?
To me, David, the only thing is always focusing on that long term. Okay, and you make sure you've got a little cash cushion. What they say, you always keep some powder dry. When we had that drop the first quarter of 2020 because of COVID, the market went down 30% the first quarter, and by the end of the year, it came all the way back and blew right through that. And there was one fund that I kind of liked over the years, and it was down 21%. And I saw an account where it went from 4.7 million to 3.7 million in 90 days. And if you bailed out, if you panicked, you locked in that loss. By the end of the year, it went up 45.5% and finished the year up 15%. It went from 3.7 million to 5.4 million.
Jeez.
Staying in the game.
Time and patience. Now, are they always going to come back that fast? No.
Right.
No. The next time, instead of it being 6 months, it might be 6 years.
Yeah.
But sooner or later, it'll be back. And what I've always preached to everybody in my 53 plus years, short term, I've been wrong a lot. Long term, I've never been wrong yet.
Yeah.
And I'm proud of that.
I love that.
Makes sense.
I love that. I think one thing with us, and just since we've gotten together almost 2 years ago, I think, and I'll let him speak on this too, but we've heard countless times from being in your office. I just heard it yesterday. I wouldn't be in this situation if it wasn't for Paul.
Yeah.
And I mean, I know I've heard it, Brandon's heard it, Nick and Lindsay, and that's just all credit to you for doing what you've done for 53 years, and you made this business very honorable. And
It's been very, very gratifying. I love what I do. I've always said the only thing I would have given it up for was to be a professional athlete, and I just wasn't big enough or fast enough. So,
well, you just got your shoulder redone, so maybe.
Yeah, right. Yeah. So
Call
it's all
the
good.
Pirates. We're gonna get you on the bump.
Excuse me. It's all good.
You want to wrap us up?
Yeah, so, Paul, like Dave said, we appreciate it. And, I think for.
Appreciate you guys.
Yeah, for some of our, younger investors, even some of our, older investors that have been with us for a while, I think the number one thing is just following these principles and making sure that you continue to put money away. You continue to let the markets do what they do, because we don't know what they're going to do in the short term, but long term, we're betting on the markets because that's what's always worked.
Yeah.
So,
well, for the younger investors out there, if they get started now, they don't have to even put away a lot of money every month to have a ridiculous amount of money at the end. And I know we had talked about dollar cost averaging, and I give that example about if you put $100,000 into something and it's $10 a share and it goes down to $5. If you now put another 100 in, your average cost drops to 7.5.
yeah.
It comes back to 7.5. You're even. It comes back to 10, and you got a 50% gain.
Yeah.
Yeah. It's like you said. It's all about time and patience. Never getting scared out of the market. And any time the markets have had big drops, I was buying like crazy to the whole time. And I had clients that asked me what I was doing, and they looked at me like I was insane.
Yep.
And I said, I've been there dozens of times.
Right.
I know what I'm doing.
Yeah.
That's it.
I think the main theme is time in the market builds wealth.
Yeah.
Timing it rarely does.
Oh, yeah. You can't do it. Like I said, you have to be right twice.
Yeah.
It's hard enough to be right once, let alone twice. That's it.
Uncle P, we appreciate you jumping on here with us today. You're the best.
You guys
You're
are
the best.
Appreciate you.